What's up, everyone, and welcome back to the Web3 Daily. It is an absolute bloodbath out there in the markets today. I don't know if you've checked your portfolios, but it's a sea of red, and the mood is heavy. Bitcoin got slammed with a massive red candle, crashing right through that key psychological and technical support. At $115,000, Ethereum plunged right along with it, and the whole market is looking pretty precarious. Honestly, while a flash crash like this is always jarring, it's also a cooldown for what was becoming some pretty overheated market sentiment. Of course, for anyone running high leverage, the last 24 hours have been an absolute nightmare. This brutal downswing triggered a massive cascade of liquidations, and that's the main event we're breaking down today. So, the main event we're diving into today is this brutal Black Monday liquidation cascade. $1.7 billion. You heard that right. In less than 24 hours, $1.7 billion in capital was just wiped out, and the vast majority of that pain was felt by the bulls. I checked the data, 1.62 billion of that was long positions. That means nearly everyone who got liquidated was betting on the price going up. Over 400,000 trading accounts were wiped out completely. 400,000. That's 400,000 real people who watched their accounts evaporate in the span of a day. The root cause of a cascade like this is simply too much leverage building up in the system. When the price dips even a little, it triggers the first wave of forced liquidations, which then acts like a domino, causing a chain reaction that ends in a stampede. Many analysts in the space are calling this a healthy, albeit extremely painful correction that's clearing some of the froth out of the market. But more pessimistic voices are worried this event has seriously wounded the bull run and that we might be heading into a prolonged, choppy consolidation period. Either way, it's a harsh reminder that you always have to respect market risk. Alright, let's shift gears from that heavy liquidation talk and look at some of the real power plays happening behind the scenes. Because while the retail market is seeing a bloodbath, the institutional level maneuvering never stops. Yesterday, an asset management firm called Strive announced it's merging with a medtech company, Semler Scientific. You might be wondering, what do an asset manager and a medtech firm have in common? The answer is simple: Bitcoin. Post-merger, the new entity will hold over 10,900 Bitcoin, valued at over $1.2 billion. A move like that catapults them right into the top ranks of corporate treasury holders worldwide. But what's really interesting here is that this could signal a new phase in the corporate treasury strategy. A phase I'm calling consolidation and acquisition. We're all used to the MicroStrategy playbook, constantly raising capital to buy more Bitcoin. A Strive and a Semler are showing us another way. Companies that hold Bitcoin can team up, join forces, and instantly expand their Bitcoin empire through a merger. It's a smart play, especially since many public companies holding Bitcoin are trading at a discount to the value of their crypto assets. So instead of slowly buying more yourself, why not just acquire another discounted Bitcoin treasury? This could kick off a real wave of M&A among corporate Bitcoin holders, so keep an eye on this space. Now, when companies like Strive start putting billions of dollars in Bitcoin on their balance sheets, who do you think takes notice first? That's right, the regulators. And yesterday, two of the world's biggest financial hubs, the US and the UK, announced they're teaming up. They've formed something called the Transatlantic Task Force for Markets of the Future. It's a mouthful, I know, but here's the bottom line. These two heavyweights are finally sitting down together to figure out how to handle crypto. So why now? Because over in Europe, the MiCA regulation is already making waves. If the US and the EU don't get their act together, the EU could end up writing the rulebook for the global crypto game. This isn't just about regulatory cooperation, it's a battle for financial influence. As soon as the news dropped, industry giants like Circle and Coinbase were quick to applaud it. And their reasoning is simple. A unified, clear regulatory framework is a massive win for the industry. Think about it. If the US and the UK can get on the same page, projects and exchanges won't have to navigate two different sets of rules. That means smoother capital flows and deeper liquidity for everyone. The task force is supposed to deliver a report in 180 days. So the next 6 months will be crucial. Keep an eye on this, because whatever these two giants cook up could have a major impact on all of our long-term strategies. Alright, after looking at the big international picture, let's zoom back in on the US. Because while they're collaborating with the UK, the political games at home are getting intense. A group of Republican lawmakers, led by French Hill and Ann Wagner, just sent a letter directly to the chairman of the SEC. The message was simple: get to work and implement that executive order Trump signed. The whole point of that order is to officially allow alternative assets like crypto into Americans' 401k retirement plans. And guys, do you have any idea how big the 401k market is? We're talking trillions of dollars. Right now, that money is almost exclusively in stocks and bonds. If they open up even a tiny crack for crypto, if just 1% of that capital flows in, it would be a tsunami of fresh liquidity for our market. And this isn't a speculative hot money. This is long-term, stable, set it and forget it retirement cash flowing in every single month. That kind of capital would be an absolute game changer for market stability and valuations. Of course, there's a ton of pushback. The Democrats and more conservative regulators think crypto is way too risky for people's retirement savings. So, this letter is basically the opening shot in a major political battle. Now we watch and see how the two parties play this out. So we're seeing TradFi money trying to get in. And at the same time, the crypto world is evolving, trying to bring core TradFi concepts like generating yield to more of the classic old guard assets. And when you talk about old guard assets, you have to talk about XRP. A lot of OG investors have a real love-hate relationship with it. They love the strong community, but they hate that for the longest time. It hasn't done much besides fast transactions. It's been practically a ghost in the world of DeFi. Well, that might be about to change. Yesterday, a project called Midas, working with the cross-chain protocol Axelar, launched a new product, mXRP. Simply put, it's an XRP that earns you yield. You deposit your XRP, you get mXRP back, and you can just sit back and collect a 6 to 8% APY. And the key is, this yield isn't coming from some inflationary token model. It's generated by professional teams running market-neutral arbitrage strategies. This is real, sustainable yield. Even more important, mXRP is built on the XRPL's EVM-compatible sidechain. That's a bit technical, but what it really means is that XRP finally has a ticket to the Ethereum DeFi playground. Lending, derivatives, all of it is now on the table for XRP. This could create what some are calling perpetual buy pressure for the token. Think about it. If there's a reliable way to earn yield on your XRP, how many people are just going to let it sit idle in their wallets? This is definitely a major potential catalyst for its long-suppressed price. The crypto market doesn't just react to tech innovation. Sometimes, its reaction to a single times person times can be even more direct and explosive. Take a look at the company backed, ticker symbol BKKT.
Yesterday, its stock price went on absolute tear, skyrocketing over 40% in a single day. A lot of people were scratching their heads, wondering what massive news could have dropped.
It turns out, the reason was simply the appointment of a new board member, a guy named Mike Alfred. So who is Mike Alfred? He's a true OG in this space. He co-founded the digital assets data, which was later acquired by NYDIG. The guy's credentials are rock solid. Simply put, he's someone who genuinely gets this industry and has deep connections and a stellar reputation among institutions, and the market is smart. Backed. Despite being backed by ICE, the parent company of the New York Stock Exchange, has been underperforming for years with a blurry strategy. By bringing in a heavy hitter like Alfred, the market's interpretation was immediate. Backed is finally getting serious. They're ready to cut the fluff and refocus on their core strengths in digital asset trading and institutional services. This whole episode really reflects the current market sentiment. People are desperate for competent leaders with clear strategies to take the helm. The right person in the right place, before they've even done anything, can earn a massive vote of confidence from the market. Paid in cold, hard, cash. We just talked about how smart money votes with its feet to back the right people. Well, that same smart money also uses its capital to bet on the future it believes in. For years, the big story has been about companies buying Bitcoin, about MicroStrategy. But if you look at two pieces of news that dropped yesterday, you see a new, equally massive narrative emerging: the rise of the corporate Ethereum treasury. First up, a company called BitMine. They disclosed yesterday that they now hold over 2.4 million ETH. What does 2.4 million ETH even mean? It's over 2% of the entire supply, making them the largest corporate Ethereum holder on the planet. But the crazy part is, they just raised another $365 million for one purpose: to buy even more. Think that's it? Not even close. Another company, ETH, also announced it raised $350 million in new financing. They already hold over 102,000 ETH, and their plan is to keep accumulating ETH and also to invest in RWA real-world asset tokenization. When you connect these dots, the signal is incredibly strong. The institutional playbook of accumulating crypto is no longer a Bitcoin solo act. They buy Bitcoin primarily as digital gold, a defensive store of value, but they're buying Ethereum for a completely different reason. They're investing in an ecosystem, in a global decentralized computer, betting on its network effects in DeFi and RWA, treating it as a productive cash flow generating asset. So while the market is panicking over short-term price swings, the real whales are quietly placing billion-dollar bets on the script for the next decade. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. We're here every day, filtering through the noise to bring you the most critical information in the Web3 world, the news closest to the money. We hope that by breaking down these key stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges in the comments section below. These are high rebate offers we've secured for our fans, and we hope they can save you some costs on your trading fees. Let's all stay rational, move steady, and get rich slowly here in the world of Web3. May all of your crypto assets grow steadily. We'll see you tomorrow.